Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abidi. Today, we're going to talk about the impact of macro news developments on individual investment portfolios. With me, as always, is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. And also with us today is Mr. Abdul Samad Sheikh, who has been an investor now for over 30 years. Gentlemen, thank you so much for joining in. Feroze, my first question is on the RBI's monetary policy. We had the latest one last week. How should investors see the outcome? Are there significant changes that it would make to their portfolios, or should it be seen more as, a directional event?
All the macro events don't, on an individual basis, impact, but on a cumulative basis, they definitely help an advisor decipher the trend which is emerging. So point one, not each news which is coming is important, but an aggregation of those, if those are speaking a language, then it is important. Like, for example, like you said, Sumaira, RBI monetary policy lately has kept the interest rates unchanged on the repo and the reverse repo. But if you look at what has happened from March till July, you see a clear interest rate fall and a stance that it will be accommodative, which means that interest rates can further go down. So that's the key messaging across these 3-4 events cumulatively. Now, what is the action an investor can derive out of it? Is one, there's a message that the old times which have lasted for Indian investors for far too long, that they can put their money in a fixed deposit and plan their retirement, for example, is gone. People will be compelled to apply more mind, learn investing, take some calculated risks to create value for themselves. Just like if you were in the US, for example, you couldn't have enjoyed a retirement just by investing in debt because the interest rates were so low. Most Indians will, and especially HNIs, will have to learn taking calculated risks to create value with their surpluses.
But Feroze, a lot of people tend to get overwhelmed with the macro news, right? So what is the advisor's role in translating these developments that take place on a macro level and actually, hand-holding investors through it, analyzing the impact? I mean, should it be done regularly or should it be done like post-event?
I think, Sumaira, you've pointed in the right direction. I think it's the role of the advisor to understand trends rather than direction. A trader needs direction, an investor needs trends. So if the advisor is able to decipher the trends which are going to emerge over the next 3 years, 5 years, 10 years, and then uses that input to develop and build a strategy on the investment side, it will be a great, macro news will be of great help. And I think it is largely the responsibility of the advisor. At least 70% of this responsibility lies with the advisor to comprehend different things to get not the direction, but the trend correct. Investors look and seek directional movement advice, which I think is a zero-sum game. So you're right, advisor's role is paramount in doing this and comprehending macro news.
Okay, Mr. Sheikh, let me ask you, because, you've been an investor now for, what, 3 decades, right? I mean, what wouldn't you have seen, right? What has been your experience? Has macro news ever overwhelmed you? How have you dealt with these situations? And, the trends as such, I mean, do you feel that your advisors have done a fair job of explaining it to you? And how do you generally analyze it and use it in your portfolio?
Yeah, so being a CA and a businessman and also having worked as a financial controller in India and abroad, I thought I knew everything about investing and finance. But there are certain fine points when it comes to your own wealth management and investing. So one important thing is that one should have a very long-term objective to your wealth, and you should never try and time the market. One should be long-time greedy, not short-time greedy. And having a right asset allocation is also equally important. And direct equity exposure should be avoided as far as possible, because I have burned my hands in that. And last not but the least, every HNI investor should have estate planning in place. And here I think I should thank Anand Rathi and company for hand-holding me and doing my estate planning to a very good, in a very good way.
Okay, so what would you look for in an advisor, or rather, now based on your experience, what would you recommend that people look for when choosing an advisor?
Yeah, so there are at least 3-4 qualities come to my mind at this moment that because money is a very important matter, your advisor should be very much trustworthy. Like Anand Rathi gets their returns, whatever they promise, they get it every year audited. So one should see that your advisor has such independent reports. Also, he should be available at various times whenever you need his guidance, and he should come handy when actually you need him. Another important thing is that he should just not think about his own incentives and commissions, but he should give equal importance to my financial goals. These are the various things come to my mind at this moment.
Okay, interesting. But, Feroze, I mean, I would imagine that there are two ways, right, to know if your advisor is doing a good job. One is, of course, you can see, with hindsight, right? You've been with somebody for 2 years, and you can sort of assess how they've done. But importantly, if I want to know before I sign on an advisor, what would be the few, 2 or 3 things that would alarm me or sort of, set the bell ringing, or alternatively, let me know that, this is the advisor who's probably going to do a good job?
Yes, so in most situations, you would be evaluating an advisor, and you may want to be forward-looking because you might not have had data points and experience. In that case, one thing which is very critical is to get audited results of performance of all the clients which the advisor manages. To my surprise, I've actually, with my industry acquaintances, checked when all wealth management outfits publish what was the performance and the risk taken for the assets they manage as an overall. So that was not there. Is why Anand Rathi a few years back, almost as much as 4-5 years back, decided to get it audited. So that a prospective client is not just deciding to deal with you on the basis of English you're speaking in that meeting, but more on the design of the mathematics, what is being delivered as you've been advising other clients. So audited results of performance, both on the return and the risk, is a good start point to exhibit capability in the business of mathematics. If there were subjective businesses where you can't express performance in mathematics, it's okay. But I think managing money is as black and white as it could get. Not having performances, I think, is a failure of several industry participants to give numerical integers to both risk and return of their existing clients to a prospective.
Yeah, that's true. Okay, what we're going to do is take a very quick break, but when we come back, we'll talk about, the trends, investing trends currently. Equity mutual flows have seen a big outflow this month. Should investors be worried? What about gold, silver? Will that rally have more legs? All of that is lined up next. Do stay tuned. Welcome back. You're watching The Investing Edge. With me are Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management, and Mr. Abdul Samad Sheikh, an investor with over 3 decades of experience. So we've spoken a bit about, the macro impact on portfolios, but Feroze, let's get more specific now, right? Because the month of July has been tough for mutual fund investors. And, the latest data now shows that there have actually been outflows. Is it that investors are now increasingly getting nervous, or is it that they need more money, or is it profit taking? I mean, what would you attribute it to?
I would attribute it to, in fact, none of these three. One thing which I have seen in my interaction over the last few months is quite a few people were caught off guard with the March and April fall. It is basically a very good performance in the equity markets between June and July, which has created some relief for investors, and they now want to withdraw their money and at least feel that the pain which they saw in March and April is gone. So every time an investor goes through a short-term, very sharp pain, he or she waits for an opportunity to come back to square one and then regather their courage to come back. So that's one thing which has happened. Second, I don't think it's profit taking, because most of the folios which would have gone out would have just broken even or made some profits. Because they went down and then came back up, it's some relief and they want to actually catch a breath and stay out. That's happening across HNI communities more so than the retail. That's one. The second thing which I think is which happens time and again, when you have sharp rallies in two expiries, like June and July, we saw an expiry of close to about 20% on indices. So this kind of sharp moves also implies that people will be doing profit taking, but the ratio of people who are actually have booking profits is fewer than the ones who are taking a relief.
Mr. Sheikh, I wanted to ask you that have you ever been compelled to actually hear news like this, or when you've seen negative returns for so long, been compelled to actually take money off the table? I mean, how have you done it? Because you have seen what the global financial crisis and whatnot, right? So how have you handled it over the years?
I think here structured products have come in very handy, because it acts as a cushion to your investment, and it protects your capital and whatever money you have invested. If I give you a simple example, with this March this year, there was a market was down by about 20 to 30%, and here this structured product came as a very handy tool, and it protected my capital as well as my returns. And during normal times also, it has given about 30 to 15% returns per annum.
Okay, so basically the plan B that Feroze talks about. But Feroze, what about this gold and silver rally, right? I mean, we thought that the top was there, and then there was a fresh one and another one, and it seems unstoppable, and investors still continue to put in money, right? What should be the strategy? Does this rally have more legs? And what do you generally tell investors when an asset class has run up too much and they're still keen to put in money there?
Most of them are, and unfortunately, ironically, keen after it has run up. So that's one. So we make them conscious that a momentum rally is basically a trader's boom, not an investor's boom. So point one. So point two is, whenever a person is looking at point-to-point returns, like last 3 years, the returns of gold, because of the last 1 year rally, would look great. But if you look at rolling returns for the last 20 years, for all 3-year time slices, the rupee return has been 12% and the dollar return has been 10% on gold, beginning 2000 till 2019, the 3-year rolling return. That helps an investor compare different asset classes on performance across different time slices of 3 years. So that's point two. Point three, what do we tell investors? If there is a consumption need of dollar for your child's education abroad, gold could be a very good hedge to dollar and the currency depreciation which rupee sees on a periodic basis of 3 to 4% an annum. So it acts like a hedge to your currency. If you have a need, then please establish a portion of your portfolio in gold, because it's an indirect method of buying dollars. And the last point which we make is have your expectations right when you invest in each asset class. And finally, if you look at the contemporary situation, I think it has run up too much because of the economic slowdown envisaged, and I think it will lose its leg of momentum much before people think it will, because quite a few people today start projecting $70,000, 70,000 rupees per 10 grams, or maybe $3,000 an ounce on dollar terms. But we personally believe that once things settle down on the pandemic, the excitement with metal, both gold and silver, which have rallied substantively, will phase out as well.
Okay. But Feroze, it looks like it's the season for these multi-asset funds then. You think they're then a short-lived phenomena, or do you think this could, over time, become part of people's portfolios?
The multi-asset, see, I think we have to be clear what is an advisor's role and what is a fund manager's role. That's, I think a multi-asset fund is forward integrating to take over the advisor's role. That's very good from a retail investor standpoint. But for most people who have already collected a reasonable amount of money where they can afford a good advisor, if they've made a good choice, that is, then they don't need these multi-asset. Multi-asset as a strategy done by a fund manager is nothing but an advisor and a fund manager together. If you can't afford an advisor, then definitely a multi-asset strategy could replenish an advisor. But if you are an HNI or almost a future HNI and you're on very well on the path of collecting enough wealth to afford an advisor, then I don't think a multi-asset strategy on a fund level will be a great idea.
Okay, that makes sense. Mr. Sheikh, final word to you, sir. You told us about the product that's worked out well for you, but I'm keen to know what has been your worst choice in 30 years? You said earlier you had burnt your fingers with equity or with direct stocks. Has that been the worst? I mean, what is it that you wouldn't ever repeat?
Yeah, so here the real estate funds have been really a bad performer, and I would not recommend anybody to go into this particular asset class. So this is what this is my experience. You asked about the worst experience, so this is it. That's all.
Okay, Feroze, and real estate is something that you've also, I remember now for as long as we've been speaking, have never ever recommended. I mean, is this a view that you're going to hold, or do you think at some point in the future, with the way property prices are falling, that demand is set to rise, and therefore people may look at venturing into realty once again?
I think every advisor should have agility. Just because you've said no to an asset class for the last 5-6 years doesn't mean that it's a no forever. Biases in an advisor's mind shouldn't exist across asset classes. So to answer your pointed question, there could be a point in time when the data indicates that there is enough steam for real estate prices to go up. At that point in time, we will soften our negative opinion on real estate. For sure, and we will not be very stuck up on an opinion given a few years back. Point two, if you look at where the situation is today, we don't see that point in the near future, at least 2 years, 3 years. Real estate will go through a lot of changes, structural changes, and settle down, and then the data will be clear enough to take an opinion. So we have been negative from 2014-15. when it was a very large debate amongst us and clients and advisors whom we have as colleagues. The debates would last hours, but today I think everybody has come to terms that the favorite asset class of India has not delivered for 6 years, which is as good as a value destruction of 50% in purchasing power, because purchasing power is a good measure of returns. And I think so we will change the opinion at a point in time towards all asset classes. You will be open as an advisor, but not today in real estate for sure.
Well, that's absolutely right. Just like we don't fall in love with an asset class, we also shouldn't despise one for longer periods of time. Let's data be the one that helps us decide. Feroze, Mr. Sheikh, thanks very much for joining in and for making this so very interesting. With that, we'll wrap up on this episode of The Investing Edge. But as we do that, we leave you with some very interesting mutual fund analysis by Swapan Chakrabarti, Director at Anand Rathi Wealth Management. Thanks for watching.
Thank you, Sumaira, for having me on the show. So today we are going to discuss about Mera Asset Large Cap Fund. Mera Asset Large Cap Fund gets 5 out of 5 based on Anand Rathi methodology of ranking. And we are giving it a strong buy recommendation. Let me share some basic details about the fund and then tell you 5 reasons why we are recommending this fund so strongly. The fund is managing somewhere in the range of 16,000 crores as of June 2020 AUM. This falls into the category of large cap, which means minimum 80% of the investments of the fund needs to be in the large cap stocks only. Today, the fund managers of the fund are Mr. Nilesh Surana, Mr. Gaurav Mishra, and Harshad Borauke. They all have been managing this fund for quite some time, as well as if you look at the portfolio design, it is basically a growth style portfolio, which means primarily the investments are done based on the future potential of beating the markets. The portfolio has 56 stocks diversified across 10 to 11 sectors. It also has 85% of its investment today into large cap stocks and 15% into mid and small cap, which is true to its style. If you look at the reasons why Anand Rathi recommends this fund, we analyze the fund based on 6 criteria. The first criteria is to look at the past returns. The second is the consistency of the returns, or which is measured in the way of standard deviation. The third is also looking at consistency of outperforming the index by way of standard deviation of alpha. We also look at futuristic data like the valuation of the portfolio in the means of PE ratio and PEG ratio. We also try to see the stock picking capability of the fund manager and the future potential of the underlying portfolio. So based on these criteria, let me share the 5 reasons why we are recommending this fund. The first is that the fund has delivered 13.91% returns since inception, which is 4th of April 2008. For the same time frame, Nifty has given 7.3% per annum return, which means a significant outperformance by this fund over a very long period. The second reason of recommending this fund is the consistency of the performance, which is measured in the way of rolling returns. Rolling returns, 3-year rolling returns of this fund is 2.65% compared to the category average of 1.24, as well as the Nifty 3-year rolling returns of 2.49. This tells you how consistently it has outperformed the benchmark as well as the category. The third point of recommending this fund is based on the standard deviation or the risk that it takes. The risk of the portfolio is measured in a 3-year standard deviation, which comes to be 20.80 as compared to Nifty of 21.25. It is also very near to the category average of standard deviation of 19.81. The fourth point why we recommend this fund is the consistency of the outperformance, which is measured in the form of standard deviation of alpha. The standard deviation of alpha of this fund is 2.85 as compared to the category average of 4.56. Last but not the least, the fund has a very, very attractive valuation in the way of PE ratio and a decent PEG ratio to make it 5 out of 5 rating as per Anand Rathi methodology, and this is the reason why we are recommending this fund. Thanks a lot.